YouTube, good morning, good morning. This is TerrenceRe, and coming to you for the opening bell. I'm gonna take you into the opening bell today on Friday. What is this? February 18th, and we'll talk about maybe looks like the market is gonna open up flat. So we'll talk about some futures trading, talk about some ways, different ways to hedge your portfolio, and I may even put another live trade on or something like that today. We'll be right back after the buffer with some trading tips. Right now, we got the VIX futures up about 1%. So vol is up. S&P 500 futures are down about 7 handles. Nasdaq is down about 2 handles. Dow futures about 90, down about 90 handles, and we got the Russell down about 2 handles. We got a little bid in the bonds. We got the notes. Got a bid under those. So this type of market open, we got you got the market sort of flat, and you got a bid under the bonds and under the volatility futures. Now, in this portfolio right here, what I currently have on, I have positions, I have 2 positions on. I actually put a trade on, I don't know, a few days ago this week, but I did not come on live to talk about it. I have the Iron Condor right now and IWM. I'm down on both of these positions right now. Uh, the Iron Condor and IWM is sitting right there in the middle. So if I come over here and we click on the trade, you can see here is my put spread right here. Still got 28 days to go. And here is the call spread. So I'm right outside, and this ruler right here in the middle, I am using the Tastyworks platform, shows you the expected move. So the range of the expected move for this particular um, options expiration is right here. It's about, look over here, they got a $13 expected move. So I'm right outside of that. So I'm sitting pretty right now for the most part. I just need I need the vol. One of the reasons why the trade is down a few bucks is because volatility has expanded and it has not contracted. So we got a bid under vol. So if I come over here and look at the analysis tab, and I'm going to make it wide so you can see. So when you do an iron condor, basically, and I'll go over, the mechanics a little bit more while we're waiting on the opening bell. Right now it's currently 9:23. We got 7 minutes for the bell. You can see here is my put spread right here. And here's my call spread right here. And so, and here's this green area. I just need the market to stay in between here. And here it is right here currently. Right. And I got 28 days. So as long as it stays within here, I'll make money. Now I did do a roll um in this trade. So what a roll, I adjusted the position. So what I did, I'm gonna click over here. And if you're using Tastyworks, they have something on here called chains, right? And you can see here's the opening position where I opened the trade, the opening iron condor, right? So initially you can see I opened it. My put spread was, well, this is where I'm currently at. So you'll see the roll was right here. So I rolled it and picked up $7, a $7 credit. So you'll say, well, why did you roll it? Right? The market was going up at the time. So if I'm gonna go back over here. I put it on, and then the market shot up some. So I think I put it on somewhere around here. So the market was going up. So what I did was I rolled up the put spread. which was when I put that put spread on, I was down here at 184, 181. Let's look right here. You can see it right here. Excuse me. 184, 181, or right here, 184, 181. This would have been the initial. This is when I initially put it on, right? And then I rolled it up. So then when you roll, so if it was right here, if I had, let's click right here. So if I was right here, then I would have bought back this particular put, and then I would have, so I would have had this one, I would have sold the close. So basically you close this particular spread and then move it and roll it down. So what I did was I just moved the spread. I just picked it up and just moved it to here. And I picked up a 7-cent credit by doing so. So initially when I opened the trade, I had $1 credit. So now I got $1.07 credit. I took in more premium. And so the main reason for doing that is to just move my position around. So I'm adjusting the position as the trade is going on, right? So those are some of the things that you can do with options, right? You can adjust the trade and kind of move, take in more credits, and when you're selling options. Most of the time when you're buying options, unless you're buying deep in the money, then you can roll down, take some profits. You can do that as well. Um, and you continue to follow the channel and you'll see me do some of these things. So right now I like the position where I'm at. Now let's say the market was to go down. Let's say we got a big down move, right? Um, then I could possibly, if I wanted to, come over here on the call side and then roll this down with the market and take in some more credit. I could continue to adjust if I wanted to, but right now I think I'm sitting at a perfect position. Like if I was going to put this trade on today, these are the strikes I would use. I would come right outside the expected move and set this trade up today like so, right? So I'm sitting pretty. I'm just down 22 bucks on it, and then we'll just continue to um, let that marinate. The ABV position is a put spread, right? So basically, the market is up. Like basically, I just looked at it, and if you look at this is a yearly chart. Each candle represents a daily. It's a day. So look at it. So if you're looking at this and you're like me, take that off. If you're looking at this and I'm just taking a bet that the market's going to go down. Basically, a put spread is a way to get short the market and take advantage of vol increase. So if the market was to go down, you would see the price of the options expand. They would get more expensive. So vol would increase, which you can get paid on that when it goes to the downside, basically. And it's a 50-50 shot. So let's look at this trade. Come out 35 days. Now I'm a little down on it. Initially, when I did it, I bought it somewhere like maybe like this. Come one in the money and maybe go like right here. Would have been something like this. Now, the reason why it says 143 for a $2 Y is because the market isn't open. Once the market opens, then you'll see the bid-ask spreads tighten up. So it won't look like this. I don't like paying over half or a little bit over. Like if it's a $2 Y, I may spend maybe a $1.05 at the most. And as the market goes down, then you'll make money. And it's more of a quick trade for the most part. Like if I get like this, if I would have put it on here and you got this little down move right here, you're out of this trade. I'm only looking to take, and there's the bell. I'm only looking to take about 50% out of it. So, and I bought it. I did not sell it. I did not collect any premium. So I need to be directionally right in this trade to make money. So, those are the things. So a credit spread, like if you sell a spread, you're taking in premium. You're going to get paid for time decay, and you can get paid directionally, but you don't necessarily have to directionally be right. When you buy a spread, you're paying for time. So you're paying up front, you're buying, and you're not going to get paid for theta decay, right? So you need to be right directionally. The iron condor I sold, I took in premium. So I want time to pass. I can get paid by time just passing, right? Or vol can contract and you can get paid that way. Or if you buy it, you need to be directionally correct. And so those are the two trades. And you can see right here on the day already, um, overall, the AbbVie, yeah, I'm down about 24 bucks overall, but on the days you see it's green 30 bucks. So you can see that it changed. So let's go right back and let's look at what's going on. So far, like checking, I have some little things that I check on the news. Um, we don't have any big news today. We do have at 10, we have the existing home sales for January. So they're gonna do that in a leading index. So both of those will come out about 10. So you might see a little jump. They're just gonna, talk about the home sales. But for the most part, the main news is the war with well, it's not a war. I don't know. I don't know what's going on over there. And my whole take on it is whatever they put up in the news is, I guess that's what we go by, whether or not Russia's going to invade Ukraine and what that'll do to the markets as far as um, oil and energy prices because of how much that region provides for the rest of Europe as far as energy wise with oil and natural gas. And so that'll move maybe some of the futures markets. And I can take a look at some of that stuff. Like if you wanted to, if you wanted to be in something that could directly relate to that, you could come over here and look at maybe, I would say, soybean futures. You see how they're up. And for the most part, any the commodities, the precious metals, they're up. But that's not so much as, in my opinion, I don't think that has a lot to do with Russia and Ukraine. I think that has more to do with inflation and the Federal Reserve trying to curb inflation. And they've already, I think right now, the market has priced in about 3 or 4 interest rate hikes this year. And so that's why you see all these commodities, you see soybeans up. Let's take a look at let's take a look at wheat futures. Wheat futures are actually side to side. But if you look at over the past year, you can see that it's been moving up. Let's take a look at corn. See, corn is up. Now these you can trade. On Tastyworks, you can come in and you can trade corn futures. Um, you can get short. This wouldn't be, I'm gonna put my indicators on. This ain't gonna be something that I want to get short in though. I mean, get short just because inflation, which I don't think that they can stop, to be honest with you. Um, so I think corn could go higher. I don't like buying stuff this high, right? Let's take a look at gold. Gold is So this is an interesting dynamic that I've been looking at myself, with looking at gold and then Bitcoin. I'm gonna take this stuff off. It's easier for me to look at it like this. So like looking at so you look at gold, right? Beasting. This is a yearly chart. Look like it's getting ready to take out the 52-week high up here at what, 1922. Now look at Bitcoin. Now, the Bitcoin hodlers will be mad. They'll be upset with me, right? I'm gonna look at the spot Bitcoin, not the Bitcoin futures. Let's look at this. Let's look at spot Bitcoin. There you go. Look at it. And so right now, Bitcoin is down and gold is up. And I've been on I was on Twitter this morning just reading some tweets. I follow Peter Schiff, and he killing them. He been killing the Bitcoiners. And so my whole thing about Bitcoin is like, do I have some cryptocurrency? I don't have enough to where I care it, one way or the other, right? But the government has shown the ability they can shut Bitcoin down just like they can shut down your accounts. Like just like they can freeze your bank accounts, which like they got some of that going on. And I think the Justin Trudeau threatened to do that over in Canada, with the truckers convoy and all of that. So, Bitcoin is supposed to be the alternative, but they can trace that too. And they've shown that they can trace that. And when they arrested, last week, they arrested this couple that, I don't know, that scammed this money, this Bitcoin. Um, they've how they caught them. So it's just one of those things where, in my opinion, I think Bitcoin is a great speculative asset that you can trade and try to make, but it's not a hedge. So as you can see, Bitcoin is down on the day. Now look at the equities. So when Bitcoin is down on the day, let me take this off. So this is my thing, right? If I'm gonna hedge my money, I want to be in something that's not going down when the market is going down. So this is Bitcoin, and this is the S&P 500, right? And this is the Nasdaq, and this is the Dow, and this is the Russell 500. I mean, excuse me, not the Russell 500, the Russell E Mini. So, and here's Bitcoin. So, what's my thing is like when people ask me about it, I'm like, what's the difference? If I'm gonna own stocks, and stocks are gonna go down, and then I'm gonna own Bitcoin, and they all go down at the same time. Tell me what's the point in that? If you're gonna own five things and they all move together, you might as well just own one thing. In my opinion, when they tell you to have a diversified portfolio, how do you diversify a portfolio, right? You got to have something that moves um, inversely, like that they move opposite one another, right? You would have to have something like maybe gold. So like if you look at gold is up. So the market is down, but gold is up. So that would be a way of hedging your portfolio per se. Um, Although I know that there are other ways. I'm saying hedging, even though I don't really believe that there's a such thing as hedging. To be honest with you, I don't really think that you can, in the sense that everyone thinks that you can either have money into something, right, and you think it's going up, or you can take some of the money out of it. That's about it. Because if you start trading against your main position, then all you're doing is lowering your risk. So you're changing up you're not really, I don't know if that makes any sense or not. So basically, like if you got $100 on this horse to win this race, and you say, well, I ain't sure this horse A is gonna win. You got $100 on horse A to win, and you're not really sure horse A is gonna win. So you say, well, instead of putting I'm gonna take another $30 and put it on horse B to win, right? So all you did was you still got $130 on the race, but you put a little bit money on this other horse because you was like, well, instead of just putting $130 on one horse, all you did was lower the risk. You can still lose. It's the same thing with trading. and that's why I like options. You can kind of like you can set up high probability trades that if you do them over and over, a certain number of times, that you should win mathematically, right? The trades that I put on most of the time have statistically, like this iron condor has a 55% probability of profit, right? So, and that's currently like it's moving. So I'm still now when I put this AbbVie position on, it was a higher pop than what it was now. It was over 50%, but now it's just 41%. So, but when I put it on, I had like a 50-50 shot because that particular trade is just up or down. So it's the same thing with the market. The same thing with like um with you owning a stock. If you're gonna own 5 stocks that correlate to the S&P 500, and then you say, well, I want to hedge. So then you trade against those 5 stocks, right? You short the S&P 500. You're just taking risk off. You're lessening your take. So the amount of money that you would have made to the upside, you're not gonna make that money anymore, right? If that makes any sense. So like if you got, if you got if you got 100 shares of Apple, which would be and you say, well, Apple is at this moment, Apple is down a little bit. So you say, I want to hedge, right? I don't want to just stay with these 100 shares in Apple. You can either sell 20 other shares or 30 other shares, or you can go sell a call against those shares. Either way, you're just taking now. Apple was to go up, you would still make money. You just wouldn't make as much money. So you just changed your risk, but we call it a hedge. So if that makes any sense to you guys. So right now, actually, Apple's got. I'm actually bearish this market. I don't think that this market will continue to go up. And we got a 42 IV rank at Apple. Got a nice little red candle. Let's go in here and see what a call spread will look like. I like to do some trades live, and we'll put some risk out there. So if I was gonna do this, I would sell Apple already got me one time this year. In this particular account, I only have one losing trade this year, and it was in Apple. And I actually like this one. That would if I would be selling the 175 and buying the 180. This is a bearish trade. This is a credit spread. Selling it on the call side. So that would mean that I want the market to go down. I would want it to stay below 175. Let's look at 175. That will put me somewhere like right in here. And all we need is, let's see, let's go look at the SPY, which looks similar. So if I was to sell this, let's look at the NASDAQ. Man, it looks like this is getting ready to rip to the downside. Honestly, it really does. But then we could get some news, and then boom, it take off to the upside. Let's see. This is what I'm gonna do. Now this is what they call getting short into the hole. Which is something that you really don't want to do a lot of the time. Let's see. I'm gonna come out about 35 days. That's my sweet spot. We'll come on to the 24 delta. If we do that, I was getting more credit on the Apple spread, to be honest with you. Let's look over here. That's a minute chart. That's why it looks like that. I want to trade live, then that way, like people that's watching the channel, you get something out of it, right? So if you come here and you watch my channel, you'll get some trades and you'll get something out of it. Let me look at my indicators. So we look like this, like the MACD is rolling over. It look like we're getting ready to get across on this, on these moving averages. Let's go ahead and let's stick with the. Just don't know which one I want to do. We stay within 28 days. Let's sell this one for 130. We're gonna pick up 134, 136 in credit. Let's sell that. Put it in for 135. Let's see what happens. I'm at 28 days. I'm in the March cycle. I sold the 175, bought 180. I have not gotten filled yet. Let's see. I'm gonna mow it down. Let's go down to 134. Not filled yet. You can see there we go. I got filled at 134. So here we go. You just got to trade, doing some live trading. Doing some live trading. So we got another trade put on. This trade is bearish. Now, what I like to do, I didn't even look at the pop when I put it in. What was the probability of profit on that? I got filled at 134. Let's lock it. So what is that? 70%. So you can see this particular trade. I just did it, but I knew it was a high probability trade. But just so you got a 70% chance of winning this trade at the onset of this trade. Now you're risking more money than you can make, but that's the whole point of doing the trade. But I'm not gonna look to take to keep the whole 134. 50%, I'm out. Once I make 50% on this trade, I'm gonna close this trade out. And so you can see over here, I got like 80% chance of getting 50% of it. So on the Tastyworks platform, what you do is I'm gonna click here, I click both of them. I'm gonna right click. You see what says close percent profit 50. I click this arrow and bam. So I'm gonna buy it back for 67 cents. And then that means that I'll keep 67 cents or $67, and then that'll be my winner. And so I got basically an 80% chance of doing that. I'm gonna put on net debit because I'm buying it back to close. Good till cancel. That means that this will stay live until I cancel it. Review send order. Bam. There we go. So that's on. So we got that. And then we got the bearish position in the AppV. And then and you can see my deltas right here. So I am short. You can see. So when you hear I'll be watching CNBC a lot, and I watch them. I watch a lot of different like media thing. Sometimes I get on YouTube. I watch other YouTube channels. I watch the Tasty Trade Network, which they do a lot of live trading. But aside from them, when you watching these people on TV, talk about stuff, you don't know, like they're talking their book, but you don't really know what it is, for the most part, and they're all telling you what to buy, this, that, and the third. That's why I like to come on here and show this, and that was the main point of me doing this particular account this year, to show you deltas, to show you portfolio management and all of that. So you can see right here my P&L year to date. We're up almost $200 on it. On the day, we're up $47. My deltas, I have -9 deltas. That lets you know that I am bearish overall this market. That means for the most part, and this account is beta weighted to the SPY, to the S&P 500 ETF. So for every dollar that the SPY goes down, my account should move $9 approximately, right? Something like that. And then my theta, $4 or plus 4 theta. So I'm positive theta. So that means that basically I'm making money on time decay, right? So I now vol, I have a -9 on vol. So for the most part, when which Vega measures volatility. So if volatility increases, that should impact my account overall negatively. But because I'm bearish, it may not. So, like if you're short, if I was bullish or neutral on all of my positions, then yeah, I'm not really worried about vol for the most part, because if the market was to tank, that call spread I just sold would help me out. And so that's that. And then I would manage by these deltas, right? So if I wanted to, like if I was my account was acting crazy and I wanted to get it back in line, I would just manage it with these, looking at my deltas, right? The market was to go up and rip a rally, I would need to lower these deltas. How would I do that? Um, Move some stuff around on my iron condor or close it. Move some stuff around on this credit spread I just sold in Apple, or close it, or just put on a bullish position, which is possible. So with that, we just I'm gonna watch the market today. Got a live trade put on, and that's that. You guys subscribe to the channel, share the channel. If there's something that particular stock that you want me to look at, you want me to go over, put it in the comments and then I'll look at it. If you just want me to just like Ray, can you just um you know give me a trade? Like if you want, like you put it in a stock, right? And I'll give you a trade for it. Now you own it once you put it on. But if you got something, you say, man, I want to put a trade on in this. Like you just came on like Tesla, like what would you do in Tesla? And I was like, today, if it was me, what would I do in Tesla? I don't know. You got a 37 IV rank. You got the market going sideways. Might probably selling iron condor. Like you could come in here in Tesla. This is something I do. I'm not gonna do it today. I'm just saying, like if you gave me a stock, could come in, I would I would rather stay either 20. I would stay 28 days here, and you come out here, I would sell the expected move in Tesla. I mean, I literally would come out. I would probably come out here. Let's see. If you sold the 760, bought the 755, sold the 1000. Yeah, this ain't gonna work because these are $10 wide out here to the upside, and these are $5. So you would have to, you don't have to, you could do it, but I would do it like this. So on Tesla, I want to do an iron condor. This is how I would do it. I will come out here and sell. I probably would get wider. Let's see. Let's continue to make this wide. Probably do this one. So if I was doing Tesla, yeah, you can. In Tesla, you could do a $5 wide if you came out here and did that, and then maybe move that in. That's what I do in Tesla. Like if I was doing an iron condor, now this is a $5 wide, and you could still take in about $160. Now Tesla can move though, so this is what I would put on, and this is a neutral trade. You see the delta basically beta weighted. If I you see, is 0.13, and the regular delta is 0.04. So this is a neutral trade, and you got a 3 for theta. So your risk is, max loss is 340, max profit is 160. So that's what I would do if I wanted to trade Tesla today. So once again, guys, hit that like button, hit the subscribe button, share. I don't know a lot of people that's coming on YouTube giving you guys trades out like this. So with that, be safe out there. Peace.